All right, let's play a straight bet from now on.
Well, we do have a 10K thing going on, so I don't know when that's coming into play. When's that happening?
I can go around and around the block. That's fine. I can do 100K as long as I can do it within 2 hours.
I'm sure you're looking forward to the 3 hours. Hello and welcome, everyone. I'm Robert Baharian, and this is Masters in Investing. On this show, I talk to guests about financial markets, the economy, investing, and business. Don't forget to subscribe and leave us an awesome review. Let's get into it. My guest today is David Haintz. David took his boutique financial advice business and, along with a few others, creating Shadforth Financial Group and monetized the company for $640 million back in 2014. During our conversation, we talk about what are the best financial and wealth management businesses focusing on right now. We talk about the future of wealth management. And really importantly, we talk about what clients need to look out for when engaging a financial advisor. Here's my conversation. I hope you enjoy it. Let's get into it. David Haintz, welcome to Masters in Investing.
Rob, good to be here. Good to see you.
Good to see you as well. Now, you were probably wondering why I've asked you to jump on to have this conversation today. I couldn't think of anybody better to talk about financial advice, to talk about financial advisory businesses, to talk about wealth management, both from a business's perspective, let's call it a practitioner, but also from a client's perspective. Because I think that there's so much that practitioners and businesses think up here and think they're doing a good job at, but also then there's the consumer and the client at the end of all of this. And my humble opinion is that more often than not, there's a disconnect somewhere. And practitioners think they're doing a brilliant job. Clients think they're doing a shit job. And it's just like, if we had a conversation about what should it look like versus what I need, I'd love to start picking your brain, because you and a bunch of others were able to do that really well, really successfully. And we're able to monetize 6 or 7 years ago now what is Shadforth and please correct me if I'm wrong, at a $670 million valuation back in 2014. And so if that's happening, I think you're doing one or two things right for that to eventuate. So that's why I wanted to talk to you about that. But I think it'd be really helpful for listeners to maybe just have a snapshot background on you, David. So I might hand over to you to give us a rundown as to how it all sort of started, what the journey looked like from, the one-man band, if you want to call it that, to consolidating, to regrouping with a whole bunch of others, to Shadforth, to life after Shadforth. So, mate, I'll just hand over to you to give us a rundown.
Okay, Rob, sure. I guess I'd preface all of this by saying I don't particularly like talking about myself, but
I knew you were going to say that, and I should have prefaced that first. But I might have put you in an uncomfortable position, but mate, please.
I think the approach that I take in this type of environment is what insights, what epiphanies can I pass on that might help people around Australia, financial advisors, et cetera, et cetera. So I'll be brief, but to the point as best I can. So 26 years in financial advice, founding a firm on my own in 1989 and made a number of errors in the first 13 years. Probably all the things that we're going to talk about later on today, I presume, about running a great business were all the mistakes that I made in the first 13 years. But then you start to get things right along the way. I think some of the epiphanies that I had along the journey, so 89, no staff, no clients, no revenue, and really starting from scratch. It was obviously a much different environment back then, much less regulation. And so, I saw the power of independence in the mid-90s and got my own license in the mid-90s. That was certainly an epiphany. I think one of the key points that I'd pass on to the listeners would be this lifelong learning philosophy. So you're never done. And I suspect I'll still be learning things when I'm hopefully 70 and 80 and hopefully 90 as well. So there's always things we can be learning. And I've always sought out what I would call global best practice, mentors. And so I picked up this notion of lifelong cash flow modeling in 1995 from a mentor over in the UK. And what he taught me was to focus on clients' goals and clients' outcomes. It was all about whether the client was on track or not on track to achieve their goals and aspirations. And we'll unpack that as we go through. I think values-based advice, I mean, I think these terms, goals-based advice and values-based advice, are almost like throwaway lines today. It's really a matter of, well, let's unpack it. And what are you doing about that? Are you really delivering on that, or is it just pure lip service? And so combining values-based advice with goals-based advice, again, I picked up the values-based piece in the early 2000s from a mentor in the US, which is all part of that lifelong learning journey. And so, the whole notion of a business plan, of an organizational structure, of a client value proposition. I think it would have been 11 years before I even heard the term an employee value proposition. So if you're going to attract and retain the best clients, I believe you've got to attract and retain the best staff. And so that opens up that whole notion around the EVP, the employee value proposition. And yes, so I hired someone in the early 2000s that would have been on, $50,000, $60,000, $70,000 as a junior admin paraplanner, degree qualified. And I guess what I witnessed through that, the noughties and the teens of 2000, that unless I was growing as a business, it was going to be hard for me to deliver the services that my growing client base needed, but particularly the employees as well. And so that person that was hired on $50,000, $60,000, $65,000 is today probably earning, in the many, many, many hundreds of thousands of dollars because he's a great operator and because he, I think, learnt great systems, great process, great value proposition in a client-centric way. The point that I'm trying to make is I recognise that I needed to grow my business to deliver outcomes for all stakeholders, not just the shareholders. And so we merged to create Shadforth Financial Group in 2008.
And who's we? Was there a big collective, David?
Yeah, so there were 12 firms throughout Australia that merged. And I'll talk a little bit about who they were and why we came together in a moment, Rob. But basically 3 firms in Brisbane, 3 in Sydney, 3 in Melbourne, 1 in Tassie, 2 in Perth. And it sounds like a throwaway line and it sounds like we got married after the first date, but those firms had very aligned values, culture, ethics, and vision. And so they came together in 2008, which created the Shadforth Financial Group. And that was April, the 2nd of April, 2008, we came together. And day one was 80 million revenue and 25 million EBIT, about $8 billion in assets, about 8,000 mum and dad clients. And we were able to grow that over time. Again, there's a lot more to it than this 30 seconds is going to suggest, but we're able to grow that from 8 billion in assets to 13 billion, revenue from 80 million to 160 million, profit from 25 million to 58 million. We listed on the stock exchange in 2011 through a reverse takeover and ultimately got taken over, as you mentioned, in 2014 by IWF for $670 million. So I guess for today's purpose, 26 years in financial advice as an advisor and business person. And the last 7 years, I've been advising advisors to help them run the best possible client value propositions that they can. So, whether it's founding, growing, building, a lot of M&A work through there as well, internal succession and listening and monetizing and seamlessly exiting is something I'm pretty proud of as well. Probably when I cried the night that we got the big check from the takeover, I was probably upset only because that's all I ever knew.
Why were you crying the night before?
Well, the night that we got the outcome and we got the check, my wife opened a nice bottle of vintage champagne and said, "Congratulations, that's what you've been working to achieve for 26 years." And I said, "Well, funnily enough, you're right, but I'm not happy. And I'm not happy because I loved my clients. I loved the team that I worked with. I loved my partners. I loved what I did. And at 48 years of age, I didn't really know what I was going to do. So it wasn't a moment for me that was euphoric by any stretch. It gave me an opportunity to move from success to significance and do something even more significant with my life from there. So I hope that gives a bit of background to the Shadforth story, Rob, and happy to take it where you'd like to take it.
Yeah, sure. There's a few things that you mentioned. And one of the things you kept talking about was this always learning, always growing. And you kept talking about growth. You said growth a number of times. And tell me if I'm wrong. Like I'm sensing from you, or what I'm hearing from you is that it's almost like you had to get out of the way to give. You talk about giving all your stakeholders the opportunity to grow. And they say you can move fast on your own, but you can move far with others. And I'm just wondering how much of it was you getting out of almost your own way to give the greater good an opportunity to elevate everybody, rather than, Dave Haintz on the highest podium and, beating your chest about all the things that you did. Because I didn't get the sense it was that at all. It was more about the collective rising above it all. Is that right?
Yeah, well, we won an award in the early 2000s, which was Australian Financial Planning Business of the Year, and we flew all of our team members up to Sydney to get that award because it was a team award. And so, I always took the view it was about the team. And look, I know a lot of people say that, but I think a few sayings that I had along the journey: if somebody else can do it 80% as well as you, get them to do it, get out of their way. I always said that I'd rather, my initial firm was called Haintz Financial Services before we merged into Shadforth Financial Group. And I always said that I'd rather own 1% of BHP or National Australia Bank than 100% of Haintz Financial Services. And so,
Sure.
If you can build a real, genuine business as a going concern, that gives you the opportunity to sit in a number of seats. I looked at this notion, maybe I'm a bit slow, but it probably took me 6 years to understand what a proper organizational chart looked like. And again, a mentor said, "What does your org chart look like?" And it dawned on me immediately that I didn't have one. And then he said, "Draw an org chart with all the different roles within the company." And of course, at the time, with 4 or 5 on the team, I was the CEO, the CFO, the head of marketing, the chief dishwasher stacker, et cetera, et cetera. And so we drew an org chart in 95 for all the boxes or roles that I was in. And then he said, design the same org chart and work out which boxes you don't want to be in, and let's start to build a business towards that. And so, again, it's not all about money. It's about fun. You've got to enjoy the journey and enjoy what you're doing. And so if you get caught doing things that your roles that you're no good at or you're not adding value at, find a way to get out of those roles.
Was there an element, or did it take you some time to go from Haintz Financial Services to it being something much bigger, whereby you letting go of a whole bunch of things? Was that a difficult part of the process and part of the journey? Because if we talk about practitioners and wealth management advisory firms that may come out of large institutions and organizations to start on their own, they might have someone helping them, but it's all them. To put the point you've just made, and someone asking you about org charts. But how did you feel? What did you go through to then let go of that? Because also at some point in time, you would have had to also let go of that client lead relationship where, all your clients called Dave and, "Hey, Dave, I need to talk to Dave because he's the guy." And how did you get over that? Because that wouldn't be an easy thing where you've built relationships over many, many years.
Yeah. So obviously there's ways that you can leverage that through pods and diamond teams, etc. I think, once you get to that $1.5-2 million worth of revenue, I think the decision that most founders need to make is, do they want to remain in the advice team or do they want to move to the C-suite in management? Because once you get to that sort of 1.5 to 2.5 million level, you can't do both. And so I would look at Shadforth and say, primarily those firms were made up with one or two or three partners that were typically brilliant advisors, but pretty poor. When I say pretty poor, pretty good compared to most, but compared to, global best practice, gold star standard, they weren't up to scratch in the C-suite. And so when we were able to bring in a genuine CFO, a genuine CEO that didn't come from an advice background, they just help you take the business to a whole new level. And then we had a game of musical chairs to work out where we were best to sit within that broader structure, whether it was in advice management, whether it was remaining as advisors, et cetera, et cetera. So I think the point is you need to work out where you want to play. I mean, this is not about being the richest person in the cemetery. It's about enjoying the journey, and you need to have fun along the way. So if you're caught up on a whole lot of stuff with managing people and you don't enjoy doing it, bring somebody in to do that.
And it's this concept of, there's a number of people that were previously working at the banks, and the banks have got rid of most, if not all, their wealth management arms. But a lot of folk who would have maybe left that job have not only left that job, but more or less and set up their own firm. They've more or less created another job for themselves. And so they don't necessarily have that freedom around owning a business and running the business. They literally have created a new job for themselves. So it's more or less the same thing. In fact, sometimes it's even more difficult because you don't have the infrastructure, you don't have the resources, you don't have a whole bunch of things that a much larger organization has. I think the concept of having clarity around what you want to do and the things that put a smile on your face. And I think that's really important, but also think having clarity around what is sustainable. How long can you keep doing what you're doing as sort of a 1 or 2 or 3 person firm? Could you constantly? It's a hamster wheel. I could be on.
I was just going to say that the give or take 20,000 advisors in Australia, and the average firm is 2.5 full-time equivalents and about $500,000 worth of revenue. Now those practitioners are spending about 20 to 25% of their time on client matters. In the US, the average firm is 3 or 4 times the size, and they're working on more likely 70 to 80% of their time on client-facing matters, because they recognise that if there's somebody else that can do, it's working on the highest and best use scenarios. If they're the highest paid person in the firm or the highest qualified person in the firm, they need to be seeing people, adding value.
They may not necessarily be the highest paid, mate.
Well, I understand that, but I guess the point that I'm making is compared to other roles within the company. I mean, a junior person in any professional services firm might be paid $50,000-$60,000, but the average advisor salary is typically at least double that. So, if they were to have an hourly rate, and I understand they don't necessarily work on hourly rates, but be that as it may, they need to be generating revenue, is the point that I'm trying to make, and pushing paper and stacking dishwashers and doing financials isn't creating revenue.
Do you think that those, and look, I'm sure most, if not all, people are working really hard to make sure they've got good outcomes for clients and working with clients and client matters that you talk about. But do you think under that model that there may be, to some extent, a disservice to their clients, to the extent that they're not actually looking at creating efficiency or exploring new ways of doing things for the benefit of the end client? Do you think there may be aspects of that going on?
Yeah, well, circling back to something you touched on 5 or so minutes ago, that was the 3 stakeholders in any value chain, advice business. It's the clients, it's the team members, and it's the shareholders. And I certainly always took the view that we needed to get all of that in equilibrium. So the clients need to get a great experience. We need to bring on to attract and retain the best people, to attract and retain the best staff. And if you get those 2 elements right, the shareholders should get a good outcome as well. the point you made a few moments ago about people leaving the banks and creating a job, I mean, in many cases, by the time you pay all the compliance costs, the licensing costs, the asset costs, PI, etc., there would be many former bank advisors that in their own small boutique firms would be earning less money in an after costs before tax basis than what they're earning at the bank, because they're inefficient. And so I think there's an opportunity to create more efficiency. So I just wanted to make the point that, I've got a saying that if clients win, advisors can win, and we can show you how you can get that equilibrium right. But if clients win and advisors win, then all things being equal, all stakeholders, including the shareholders, should win as well. And I think it's incredibly important to get that balance right. If you look at the global financial crisis, 2008, if you look at COVID in the last 12 months, if the shareholders fail, that means the staff don't have a job, and it means the clients haven't got an advisor. And so it's a three-legged stool that if you've got two legs, it's not going to cut it. You've got to get the equilibrium right.
I think you are, mate, spot on. I think that's a really good way of explaining it. The three-legged stool. The concept you were talking about before around Australia versus our counterparts in the US and the way they're sort of set up, etc. What do you find some of the most successful firms, advisory and wealth management firms, what are these folk focusing on? What is the thing that differentiates them genuinely to the guys down the road or the folk upstairs or whatever the case may be? What are they focusing on?
You're talking about the US versus Australia as an example?
As an example, but even in Australia, within the Australian market, what are the good firms doing that separates them from the others?
Well, firstly, let's take the US Australian thing first. I mean, they're different countries with different regulation and different propositions. So to be fair,
and a different market size too, as well. The US is much larger.
Right. So, but there are some fundamental differences. So one of the key ratios that I would look at is revenue per full-time equivalent. So if you take an advice firm, total revenue, and you divide by their headcount, in Australia, give or take, the average is going to be about $200,000 of revenue per full-time equivalent. And so if you look at what that is in the US, it's typically 380,000, give or take. So not only is it nearly double,
double.
And so why? You've got to unpack why. Why are they more efficient than we are? Well, different regulation. They typically have discretion over the portfolio, whereas we're typically advisory. They are typically asset management only, whereas we are more holistic and comprehensive advice. We have to produce a lot of regulation, red tape, statement of advice, ROAs, fee disclosure statements, etc. So we're arguably over-regulated here.
Sure.
But I guess the way I look at that as a business person is what would need to happen in order that we can help a firm in Australia to move from 200,000 of revenue per full-time equivalent to 300,000 of revenue or 400,000. There are firms that are achieving that in Australia. So it's not impossible. In relation to what the best firms are doing, I think broadly, Rob, the best firms are really client-centric. I think the best firms are very clear on what problem they are trying to solve. Now, if you think about where financial advisors come from 20 years ago, 30 years ago, it's a new-ish emerging profession, and I'm happy to pick up on that as well if you wanted to. But, we've come from phase one, which I would say was product-led and product-paid, where the advisors weren't really advisors. They were product distribution that got paid a margin for selling a product. And so the advisors were the price taker. They were told by the product manufacturers what their time, what their margin's worth. And in Australia, certainly we've moved through to phase two. Phase two would be advice-led, but still product-paid. And so leading with advice, leading with clients. But where the critical pivot is in phase two is pivoting from the advisor being, they're still product-paid, but being paid as the price maker, not as the price taker. In other words, They're in control of their own margins based on the value that they're adding to the client. They're no longer taking the margin told by the product manufacturer, the product distributor, this is what your time's worth. And so phase 2, phase 3 is to move towards advice-led and advice paid. And so I think when we get to advice-led and advice paid, we will be a profession. We're moving towards that. My experience is Australia is the most advanced nation in the world when it comes to financial advice. I do a lot of work in a lot of countries, Hong Kong, Singapore, 15, 20 years behind, South Africa, 25 years behind. So we are highly regulated, arguably overly regulated, and we're heading in the right direction. But the best firms are crystal clear on the problem they're trying to solve. And so that comes back to the value proposition. I think many advisors around the world are still trying to solve a problem with product. And so I think the best advisors would say, well, we wear 3 hats. Hat number 1 is doing amazing discovery to really deeply understand our clients, our prospects, what they're trying to achieve, what their goals are, what their values are, et cetera, et cetera. So hat 1. Hat 2 would be amazing strategy. This is where you are now. This is where you'd like to get to. These are the strategies that we would deploy if we were you. And the third hat, if you need the third hat, is a product-based hat. So the best advisors are operating on that model: discovery, strategy, then product. They're advice-led and advice paid, but they're clear on the problem they're trying to solve. And in my opinion, Rob, the problem that we have to solve today, 20, 30 years ago, it was a product problem. We get that. Today, Pete, the value proposition today, I think, is helping people to live rich, not to die rich. People want to live their best possible life, whatever that is. And so, sure, we can give them BHP shares, Rio shares, we can give them active investments and passive investments, but why? And so the best advisors are much better at the why and moving that conversation up above the line to really deeply find what's important to their clients.
Do you think there may be times when clients themselves don't even know why? And my feeling is you're going to say, well, Rob, that's the advisor's job to help them uncover the why. I just wonder, though, how often people get frustrated and they're like, this Dave guy's talking about a whole bunch of shit that I don't even want to talk about. And when Dave does the right thing to try and uncover and understand and discover, and it might take weeks, man. It might take months to actually go through this process. I don't think you can expect me to come see you as my financial advisor and not have any context or perspective. The very first moment you meet me, you ask, and I don't know you from a bar of soap, and you ask me about really deep things, really aspirational things. And I'd be like, piss off, mate. I don't know you. I've come here because I've got a loan over there I'm paying too much interest on, and I've got some shit over here that I need some help with. How do advisors tackle that? How do they hold the hand of the client, do it in a respectful way, in an empathetic way? So I know I can understand your frustration, but let's go down this journey together. How do they do that? Because otherwise, you piss your clients off, they're just going to go somewhere else, and somewhere else is probably going to patch up that problem for right now, but then something else is going to crack beneath that. And that might take time. You're smiling, and people who listen to this can't see your face unless they watch the video. But why are you smiling and laughing?
Well, I'm smiling because it's a typical comment, and so you've heard me talk about above the line and below the line before, Rob.
Sure.
And so
just explain that. Yeah, sure.
Yeah, just to unpack that. Below the line is the money, the products, the investments, the mortgages, the risk insurance, the superannuation. And so that's been the proposition of the past, all below the line. And above the line is people's goals and aspirations. It's the why. So below the line is what we do and how we do it. Above the line is why we do it. Now, if you meet someone, I was going to say on a plane, but it's a long time since we all got on a plane. If you meet someone, well,
at a coffee shop.
Whenever we can meet someone and they say, hey, Rob, hey, David, what do you do? If you say, I'm a financial advisor, what do you think the next question is they're likely to ask you?
Oh yeah, mate, I get it. You know, I run an advice firm, and you chat to people, and they say, "Oh, what do you reckon of the stock market?" I'm like, right. I don't fucking know what the stock market's going to do. Like,
so that's the point, right? So we've got 10% of Australians taking advice, 90% that don't take advice.
Is it 10% of Australians that take advice? Is it?
Yeah, 20% have taken at some point. 10% are paying for ongoing advice.
Right.
And so, part of my success to significance is, so what would need to happen in order that we can increase that penetration? Now, I don't think ASIC's helping, but that's a whole other conversation. The point I want to pick up on here, the above the line, below the line, you meet someone, hey, Rob, hey, good to meet you. What do you do? I'm a financial advisor. Is the market overcooked? What do you think of cryptocurrency? And so the average person that doesn't really understand what proper advice is goes immediately in below the line into investment product returns land. And so the best advisors would say, well, sure, Mr. and Mrs. whoever, sure, we can help you with all of that. And we've got a view on crypto and we've got a view on markets, et cetera, et cetera. But before we have that conversation, what is it that you're trying to achieve? And you move them up above the line. If they say they'd like to get a 4% return, 8% return, 10% return, why? Why do you want to get that return? Oh, I'd like to get my kids through private school. Well, how do you know you need to get 4%, 8%, 10%, 20%, whatever it is? And so most of them have never done the maths. They just think that's they want a higher return, they want a better return. Exactly. So I think the first point is the advisors have got to get better at articulating their value proposition, and that goes both verbally and on websites. So if you look at the average financial advisor website today, most of them talk about what they do and how they do it. It talks about, we do risk insurance, we do mortgages, we do superannuation, we do employee share plans, whatever it is, right? So, but the better ones are connecting on a deeper level, and that's about helping people to live rich, not die rich, and live their best possible life. So, as an example, it's only an example, and I know there's all sorts of different models out there, but I would say good practice for financial advice firms is to get rid of all the financial pornography in their reception area. AFR, Australian Financial Review, Shares Magazine, all of the financial stuff, go and put it in the bin. And depending on what your client base looks like, get caravan magazines, fishing magazines, travel magazines. And so it's changing the dynamics. It's the website, it's the reception area, it's removing the Vanguard 100-year history of the share market from your boardroom and putting up something that's more meaningful to your client base. It's about the why and about the outcome. So I think...
But I think you do that not just as a marketing pitch and a marketing stunt. I think you genuinely need to believe, to your point before, if you have clarity around what you're doing and the problem you're solving, I think that then naturally becomes a genuine... It just becomes the feel, the vibe. That's what you live and breathe.
When you completely buy into the fact that you've got an above the line value proposition doesn't mean you don't add any value below the line. Quite the contrary. And so we can unpack that a bit more in a moment. But your question a few moments ago was in relation to a discovery and asking all these deep questions. If your website talks to living rich, not dying rich, living your best possible life, if your initial conversation talks about that, when they come into the reception area, if the shares magazine's removed and the lifestyle magazines are in there, and there's celebrating the wins photographs and testimonials from previous clients, and so it's this whole end-to-end journey. And so we've already told them on the telephone that we're going to ask them these questions. We've told them in the letter that's been mailed out to them prior to coming in that we're going to ask them these questions. Then we have a hard copy agenda, and we run through what the agenda is before we get to each of the particular questions. So we're not catching anybody by surprise with any questions. Obviously, the number one thing you ask a prospect when they come in, even before you pull out any agenda, is to say, how can we help? And just remind us why you're here today. What is it you're hoping that we can help you achieve? So, some of them have got an itch that they want to scratch and get that fixed straight away. Some of them want more macro, holistic, comprehensive advice. So unless we scratch the itch they've got, they're not going to be happy. And so you've got to deliver on that.
I think that's what I was sort of getting at before. They come in with one problem. Yes. It's like you take your car to the mechanic and because there's a light on, and then the mechanic tells you that it's your fan belt. But while we were looking at that, unless you fix my fan belt and make the red light go away, I don't care what else you're going to say to me. And I'm sure they'll find other problems, which inevitably they do.
Well, it's interesting, Rob, because the last 7 years I've been advising advice firms, and it's exactly the same analogy, because an advice firm would contact me and say, David, we'd like you to help us with our value proposition. And I said, well, sure, I can help you with that. No worries. But why is it you want to focus on that? Oh, because that's the only thing. It's like the fan belt in the car. That's the only thing we need to fix within our business. And my experience in 26 years running businesses and 7 years advising businesses is there is always another or multiple other elements that need to be fixed. It's never, ever an issue in isolation. So what about your client services, your client segmentation? What about your pricing model? What about your communication? What about your advisor training? So it's like the fan belt in the car. As advisors, the best advisors are looking at things holistically and fixing problems that prospects don't even know they have.
But I think it's if that's the type of offering that you want to pitch. I mean, probably a different or better example might be if you go talk to an architect and you say, oh, I want to redesign my kitchen. And the architect says, I hear you, man, but yeah, we got to actually do this thing over here and this because it's the big picture. If you're only looking at that, maybe you don't need an architect. Maybe you just need a kitchen designer who can design and fit it out for you.
Yeah.
And I think maybe it's more so the pitch about what you're doing and what service you're offering and for who. But I think that goes back to, and tell me if I'm wrong, the problem that you're trying to solve. If that's the problem you're trying to solve for people, naturally you'll attract those type of problems, I imagine.
So, one other point, Rob, you mentioned a few moments ago, I just want to pick up on was around that discovery process and asking some of these deep questions. In the discovery, and I think it's really important, some advisors don't call them discovery meetings. I think discovery is the right word because in professional advice in 2021, this is not a one-way discovery. This is a two-way discovery. The advice firms should be discovering whether or not they are able to add significant value to their prospect for whatever fee they would need to charge. Of course, the prospect needs to determine whether the advisor, the advice firm, is going to deliver significant value for whatever fee they're going to get charged. And so it's a two-way discovery, but I just want to spend a minute unpacking what I would call a 3- and a 4-way discovery.
Sure.
And I think this is really important because for me, of all the meetings we have with clients, I'm not a golfer, but people tell me if you play golf, the most important shot to practice is your drive. You've got to get it off the tee and you've got to get it down there. Well, so they say. So for me, the discovery meeting is like the golf swing. You've got to go down to the driving range and get a bucket of balls and you've got to hit them. And advisors need to get a whole lot better at that discovery meeting. If they feel like they're asking questions that's prodding and prying, then that's how it's going to come across. They're going to be embarrassed. They're going to be nervous. If they feel like they're going to change these people's lives by asking really important questions, then they're going to change people's lives. There's an old saying that you need to make people cry before they buy. And if you ask the right questions in that discovery meeting around what's important about money to you, around your goals and your values. I recall one time I asked Peter and Julie, this has taken me back 16 years now, but a client came in, they had a great business, making good money, $3 or $4 million a year, and they would have been mid-30s. And I asked them the question, what's important about money to you? And there was a pause, a dead silence. And it's the old saying, he or she who talks first loses. So I just said, look, there's no hurry. There's no hurry at all. Just remind me, tell me what's important about money to you. And cutting a long story short for the listeners, Peter said, well, you know what? It's just dawned on me. Firstly, no one's ever asked me that question before. Secondly, when I was a kid, I was raised on a dairy farm in Gippsland, chasing cows, riding motorbikes. And it's just dawned on me now I'm making all this money in a business in Melbourne, but I want my kids to have the upbringing that I had. Now, 3 or 4 or 5 years later, Peter and Julie went and bought a dairy farm in Gippsland and sold the business. And he said, I want to thank you for that conversation we had. Now, he would have intuitively known that, but he needed a nudge. And so I talk about this discovery being 2 ways, was the 2 ways I mentioned a bit earlier. The 3 ways is someone discovering or rediscovering themselves through that conversation, through that meeting. And that was Peter saying, hey, I want my kids to be raised on a dairy farm. But the 4-way discovery is because you've got a couple in there in most cases. You're asking what's important about money to you. You're unpacking their values. Sometimes you're asking questions to one of the couple that the spouse has never heard been responded to before. And so sometimes the spouse gets to know their spouse even better as well. And I put to you that most people around the world would spend more time, this is probably a bad analogy right now with COVID, but they'd spend more time organising their vacations than they would organising their financial lives. And so it can be a really great, deep four-way discovery if we get the structure and the questions right, Rob.
I think, I don't know the numbers, but I would bet that that's probably right, where you spend hours and hours on trying to book a holiday, this hotel, that tour group, this tour group. Imagine if people spent that amount of time on being able to be able to achieve 4 holidays over the next 4 years rather than just that one big one. And anyway, I hear you, man. I think that's a really good example. There's a couple of things that you talk about. The concept of crying before you're buying. I think Apple do that really, really well in engaging their consumers. So yeah, Apple sell, iPads and wristwatches and whatnot. But I think you can call it marketing and spin. I call it that, or call it genuinely understanding your customers and connecting with your customers and your clients and knowing what the problem your product solves. And I think product can be interchanged with service. Because then you can focus on those things. And the one other comment you made before about the state of mind of you're at the driving range and, if you think you're going to shank it, you're probably going to shank it. If you think you're going to hit it, for the next 100 yards, you'll probably hit it for the next 100 yards. I think that state of mind is really, really important. And most people will see through that. Most people will pick it up just intuitively. They'll pick it up, they'll sense it. And I reckon you've killed it from the moment that you sort of open your mouth. So the belief around one's value proposition for clients and genuinely believing whether that is what they do, I think could probably be a deal maker or a deal breaker. Oh, were you going to say something?
Yeah, well, I was going to say the 3 words that I use in relation to that, Rob, is understand, believe, articulate. Now, whether it's your below the line proposition, whether it's your above the line proposition, advisors need to understand what their proposition is. They need to believe it or not believe it and change it. And then they need to articulate it in that order. Now, what I see is so many advisors get told what their value proposition is and they try to articulate that. They jump straight to the articulation. They've never bought in with their heart and soul and mind. And so my experience is you don't need training about articulating a message on a below the line proposition or above the line proposition. If you understand it and if you believe it, you talk with your heart, not with your mouth.
Massive, 100%, man. I remember 100%. I remember at the bank, like we would do so many like training sessions and scripts. Man, we'd have scripts in our freaking desks. And and even to this day, a lot of folk do sales training. I think that's all good and well, but if you don't believe it in your heart and if you don't speak with your heart, it's just a bullshit script. I could never get myself to read it out loud. I felt like a dickhead, like reading out something that wasn't even in my own words. And they say, change it into your own words. No, if it's not coming from here, it doesn't matter what comes out of your mouth. It's not going to work. Exactly. So I think that's a really important piece. A couple of other areas I want to move on to. The first one being, you talk about below the line being, interest rates and markets and investment. If people are spending less time there, so if I've got, 8 hours in a day, let's just say, and I'm spending less time there and more time on the above the line stuff that you talk about, how do advisors and how do wealth management firms and advisory firms become more efficient on the below the line stuff?
Mm-hmm. Well, firstly, obviously there's a lot of elements to running an advice firm. I mean, it sounds straightforward. You've got, 50 clients, 100 clients, 200 clients, 3 staff, away we go. But first and foremost, you've got to be clear on what you stand for from an investment perspective. And I know we talk about this, what problem you're trying to solve and your client value proposition. But my experience is you can have the best possible desire to improve, to build your client value proposition. But unless, it's like building a house. You've got to build a house with solid foundations, and the solid foundations of an advice firm is your investment philosophy. I know it's below the line, but that's what's going to give you the capacity release to work on everything else. Yep. You can have the best endeavors as an advisor to say, I'm going to spend this week, next week, half a day a week, whatever, working on my CVP. But if you constantly get pulled and sucked back below the line because of markets, because of COVID, because of the GFC, then you're going nowhere. So you've got to build that solid foundation with that investment philosophy. And I see so many firms that have got we'll talk about the number of firms that have or haven't got a business plan in a moment. But for those that have got a plan, that have got a vision, most of them want to grow. Rightly or wrongly, they want to grow. And if you look at where they are 3 years later or 5 years later, most of them aren't anywhere near where they'd like to be because they haven't tidied up that investment philosophy below the line. And so if I give you two really good examples, I think if you look at IPAC in the mid-90s, early 90s, IPAC back then, it's very different today, but IPAC back then only had solutions in their portfolios that was CPI plus 3, CPI plus 4, CPI plus 5, CPI plus 6. Now that was it. And that was in their kit bag. So they got on with everything else. And whether those portfolios added value against the benchmark or detracted is a whole other conversation, but that's what they had. That's what was in their kit bag, and they got them with the value proposition. Shadforth, at Shadforth, we stood after lots of different conversations in our investment committee. We stood for an evidence-based approach. We built some portfolios at asset allocations of 50-50, 60-40, 70-30 from a growth defensive perspective. And because we had clarity around what those portfolios looked like and how they were constructed.
And why they were constructed that way, presumably.
Right, absolutely. So it's not just the what and the how, it's always coming back to the why. And evidence-based is evidence-based. That means you've got evidence and data to back up and support why you're doing it. And, it's interesting, one of our philosophies, which might not sound overly enlightening right now, but it was to invest our client money the way that we would invest our money. Now, intuitively, I would have thought that's what most advisors should be doing anyway, but that was certainly something that we stood for. The point being, that's going to give you the capacity release. Personal plans. We talk about business plans. 30% of financial advice firms in Australia have got a formal, documented, working business plan that they look at on a quarterly basis. To improve that, you've got to get a capacity release to get time. But who cares about a business plan? What about your personal plan? The business is what's supporting you and other practitioners in their own lives. So what about a personal plan about what you're trying to achieve in your own life? So personal plan, business plan.
A plumber with a leaking tap in his own house, David, right. It sounds like.
The painter always needs their house to be painted. But we talk about the CVP. I mentioned a little bit earlier today about the employee value proposition. It can be frustrating to attract a great team member, but then when we lose them, we say, gee, I lost so-and-so, damn it, I've got to go through this process again and pay recruiting costs, training costs. It takes 18 months to break even before we get somebody, before we get the right person and it's profitable. What would need to happen in order that we built an employee value proposition? We need the capacity release. We need the time to be able to work on that. The client segments, the client services, the pricing. In years gone by, the segmentation was done on assets under management and therefore revenue, but that's nonsense. The airlines have got this one absolutely nailed with first class, business class, premium and economy. They've got different services, different segments, different pricing. They don't take the first class food and wine down the back of the plane, and advice firms have got to get way better at that. And so I'm just trying to
Are you saying firms do push the trolley cart, from the nose of the plane to the tail?
Absolutely. So if advice firm clients knew they had a choice between first class, business class, premium and economy in a segmentation sense and a pricing sense, people that are paying first class and business class tickets, 10 grand, 20 grand, 30 grand, in many cases, the value proposition is no different from someone who's paying them a lot less. And so I think if people knew they had that choice on the segment, they would elect and say, I'm really happy to go economy or premium economy. And that's because the advice firms are segmenting more often than not on assets under management or on revenue, and not another way.
Yeah.
So how we got to this conversation, Rob, was talking about all the elements and facets of running an advice firm. And I just want to make the point crystal clear that the future is above the line, but advisors will never get that right unless they can have a solid, robust, evidence-based investment philosophy below the line that won't let the client down, that will keep the client in their seat during difficult times, and will mean the advisor can structure some really great education and information for their clients around that.
I just, when you're describing if you don't have sort of that solid footing and the grounding, when we could, I remember going to like indoor play centers with the kids, and I don't know if you've ever been in one, but there's that in the indoor play center, there's that netted area where you go right into the middle and the heart of this, monster of an indoor playground. And there's this high sort of this high vacuum that's sucking, and it's got sort of pipes and vacuums popping out all over. And you put the softballs in there, and they pop up all over the place. You put it over there, and it sucks it in. And I kind of think about if you don't have that grounding, you're the advisor, or you're that kid stuck there with all these softballs, vacuum cleaners sucking balls out of your hand and popping them everywhere else, and you're being pulled in directions, and you don't have any control, and you're being dictated to by third-party elements or aspects of life. And I don't know how you can forge your own path if you're allowing external factors to sort of control you and what you do. And I never really thought about it that way. I think that's a good way about thinking about it. So if we wrap all of this up, because at the end of all of this are clients, and there are human beings and people that entrust someone to come in, or a group of people to come in and either challenge their thinking or validate their thinking or guide them and help them. Like if advisory firms don't know what the hell they're doing, how on earth can we expect, or can clients distinguish the right people to help them versus the people that may not be as well as equipped? I mean, you can, if you want to use an easy way out and say, oh, it's your gut feel, you're probably right. And don't give me that answer, because I'm looking for something more substantial. Surely there must be another way for the end user, our clients, our customers, or the clients and the customers, to be able to say, have a bit of a checklist almost, to go, well, this is the type of folk we need to be working with.
So firstly, let's talk about the clients. It always starts and ends with the client, no question about that. But I think from an advice firm perspective, again, I've mentioned it a couple of times today, but we need to be crystal clear on what problem we're trying to solve and build and articulate the value proposition around that. Now, for me, I believe that it's all about future lifestyle goals. It's all about living rich, not dying rich. I don't want to die with $100 million in the bank. I want to die with $1 in the bank and live the best possible life I can. And so, no matter what your wealth is, people want to know what their number is. They want to know whether they can keep the heater on in winter, the air conditioning on in summer. Maybe it's helping kids get into the property market. Maybe it's buying a shack down at the beach. The point I want to make here is that there are so many calculators out there that are what I call single purpose. Lots of calculators tell you how to pay off your mortgage quicker, how much life insurance you need, whether you're on track or not to have a certain amount in superannuation. And that's all really interesting. But people want to know, what's my number? What are my trade-offs? Rob, I could potentially retire at 55 and go and live in Ballarat or Bendigo, or work until 65 living in Melbourne CBD in a higher property market. There's no right or wrong. It's a trade-off. What about setting up a PAF and giving money away to charities? What about getting kids into the property market? So what we need to find is solutions where our clients can determine their number based on their trade-offs, because life is a series of trade-offs. And so I'm really, I guess, targeting through this conversation financial advisors to build their own proposition. Why have we only got a 10% penetration? because we haven't built the advice model of the future yet. And so part of what I do now is trying to take great software from Australia overseas, or bring software from overseas into Australia to try and help the penetration of financial advice. So we need to get those models right within our own firms. Then, from a client perspective, how do they choose the right advisor? Well, I think part of the answer, Rob, is in the penetration we've got in the market. 10% of people are paying for advice right now. So why is it only 10%? People could argue different things. It's too expensive. It's too complicated. There's too much compliance. I would argue that the average advisor is not delivering on the proposition that the average person in the public is looking for. They want to know value. And what's that value? There's tangible value about saving.
Why do you have to articulate value? Like, do you ever, I don't know, go to your doctor and say, was this a valuable consultation? Like, no, you go and you have your consultation, or you go engage an architect, or you go get your car fixed, or I don't know, maybe these are low quality decisions that we make in life, but why do we spend so much time on value? Is it because we're not adding value that we have to spend so much time trying to work out how much value we're adding? I mean, I'm just genuinely curious how often we ask that question about other aspects of our life.
Yeah, well, I can't speak for anybody else other than myself. And whether it comes to an architect, an accountant, a lawyer, I've got a tradie that's going to do something for me shortly that's going to cost $5,000 or $6,000. So I'm looking for, personally, I'm looking for value in everything I do. When I take my car to my motor mechanic, I value the guy happens to live 2 or 3 doors down. I happen to trust the guy implicitly. And so I go to bed at night. So there's the tangible value, knowing that he's not ripping me off, but then there's the intangible that helps me give the peace of mind, knowing that I've got someone that I can trust there. So I just think in any business, Rob, in any business, and I'm looking at this from the business person's perspective, not the client or the customer perspective, but in any business, whether it's advice, architecture, building, they have got to be clear what their value proposition is, what problem it is they're trying to solve. And I think the better businesses are able to articulate what that is. And so why it's even more important in financial advice, because it's such a young industry. If you think 20, 30 years,
sure,
architects have been around for years, lawyers, accountants, tradies, whatever. But 30 years ago, centuries, right? So it's a new area, and many people think all we do is invest money. Many people see that the penetration of non-forecasting approaches has moved from year 2000. 2% of money was invested in the world in some form of non-forecasting, index, evidence-based approach, and that's moved with the internet, with knowledge, with information. That's moved from 2% to today, 50% of money in the world is invested using some form of non-forecasting, evidence-based index ETF approach. That's a huge swing in 20 years. And so advisors have got to say, hey, in many cases, not all cases, but in many cases, I'm not adding value below the line. Maybe they should be in the Vanguard index fund or whatever, but I've got to start to build my proposition on everything else that I do. And that's helping people know their number.
I think the latest number, David, on that is, I think over the last 12 months, the likes of Vanguard and passive, let's call it ETF money, saw more inflow in 1 year than the prior 25 years combined. And so I think there is an evolution that is happening, and we are seeing it. And that might be for a variety of reasons, but all of those are contributing towards a very different investment community, which I think more and more people are realizing that you may as well just go and buy the index and I don't know, dollar cost average, regularly invest and save and take the long view and behave in a certain or not behave in a certain way. And they're the things you can control versus the things that you think you control but have no control over whatsoever.
Well, and that sounds easy, Rob, in the sense that, going into a low-cost broad diversification fund. But of course, human beings have emotion. And whilst they might not think today they have that emotion, at the depths of the dot-com bust, at the depths of the global financial crisis, at the depths of COVID, we all know people, I was going to say rightly or wrongly, that have wrongly cashed out of their portfolio, locked in a 30% loss, and they're never going to get that back. So, there's all sorts of data out there. That the Delbar data out of the US shows that the average US investor is detracting at least 2% per annum on equities, and closer to 4 or 5% of fixed interest, because they're getting in and getting out at the wrong time, making decisions on emotions. So this is all part of the value that advisors bring to the table. They've just got to get better at articulating that.
Yeah, and I think we need to remember, though, that advisors are also human beings, and we go through emotion as well. And you've been doing this for many, many years, and I'd be surprised if you said that you didn't feel uncertain at times. Through COVID, I don't think many people have lived through such a pandemic and what implications that has. So I think it has emotion. There's emotion we can't control, but I think with a community and a group of people helping each other and supporting each other, I think that's part of the value that advisors add. But I think it's also trying to remove, because I can very easily, Dave, talk to you about your situation a lot easier than I can talk about my own or live through my own decision making, because when you're so close to it, it's really difficult for you to see through. It's easy for me to tell you what to do, and it is for you to tell me what to do, and so forth. So I think those things are really important. I might wrap it up.
I think, Rob, that's the power of, that lifelong learning that I spoke about at the start, the importance of financial advisors getting into study groups, the importance of financial advisors, if they're not big enough to have a formal board structure, having an advisory board that meets on a regular basis to help them, to educate them, to keep them disciplined, keep them on track, keep them focused, etc. So I jumped in there, mate.
No, I wholeheartedly agree with you. I think from a client perspective as well, there is a muscle that new and potentially new investors need to build. And I could sit here and talk to you all day, but unless you have firsthand experience with something, you're going to learn more out of that one experience than me sitting here telling you what to do or not to do over 2 years. Mm-hmm. And so I think more people can just roll their sleeves up, get their hands dirty, and do a bit of learning themselves, build that muscle. It'll take time. You don't see a crisis every 12 months. It takes, we've all got recency bias, and that's why most folk are probably optimistic now, because nothing's happened other than, I put COVID to the side, but nothing's happened since 2008. That's almost 15 years of, a raging bull market, more or less. And I think a bit of personal experience goes a long way. David Haintz, I really appreciate your time here. I think there's a lot of gold nuggets here that most people can take out and learn from. The difficulty is, and the challenge is, not only listening to that, but actually then going and doing something about it. The employee value proposition, the physical plan, the every 2 weeks we're going to do this, or whatever it is, it's the execution. But if you are caught up as a practitioner dealing with client matters every single day, I just don't know how you find time to be able to go and do those other things, unless your personal aspiration is to, be neck deep in all of it. And, if you want to spend time with your kids and out on the golf course or on the bike, generally you don't have much time for any of that stuff. So, mate, I'll wrap it up. Brilliant seeing you. It's been a little while and good chatting. I appreciate your time.
Rob, good to be here. My final comment would be, I think you hit the nail on the head. We didn't rehearse this, but if people got something out of today, please do something with it. There are so many 100%. People listening to so many things, but the difference between doing and listening is the key. So I hope that helped, and good to see you.
Thanks, Dave.